You're told that Europe's economy is stable, a grand project that has weathered every crisis, but the financial security you take for granted could be at risk. That's because the official story told by leaders in Brussels and Frankfurt is designed to project strength. Behind that facade, the Eurozone is suffering from deep structural flaws that are pushing it forward a breaking point. The official narrative is a dangerous misreading of reality. And today I'm going to show you the proof that the Eurozone is quietly falling apart. Hi everyone, I'm George, a PhD economist, and before we start our analysis, hit that subscribe button. 95% of you, my dear viewers, have not subscribed to my channel, and I know you can find some value from my analysis. Also, it will help a lot to spread ideas like this one to more curious minds like you. First, let's understand the official narrative. On the surface, it seems convincing. We are told about a modest economic recovery, a sign of the bloc's ability to bounce back. The European Commission's Spring 2025 forecast projects GDP growth of around 0.9% for the euro area in 2025, picking up to 1.4% in 2026. Inflation, the monster that hunted that global economy, seems to be tamed, with figures expected to get close to the ECB's 2% target during 2025. And indeed, the ECB announced that they reached the target in the previous meeting. Then there is the banking sector. After the near-death experience of the last decade, we are assured that European banks are now fortresses of stability. And at a first glance, the numbers support this. An S&P 500 global report in early 2025 noted that the outlooks for most European banks were stable or positive, with 75% of ratings outlooks being stable and another 19% positive. They talk about solid profits, strong capital, and plenty of liquidity. Even in the first quarter of 2025, European banks defied the gloom with surprisingly strong earnings, beating profit expectations. Finally, proponents point to the political will that has time and again pulled the Eurozone back from the brink. They cite the creation of rescue funds and the massive interventions by the ECB as proof that leaders will always do whatever it takes to save the euro. This is the confronting story told to investors and citizens, a story of mudding through, of a union that's flawed but functional, but if you look just beneath the surface, you will find a machine riddled with cracks. You discover that the official narrative isn't just optimistic, it might be a dangerous misreading of reality. You see, the stability of the Eurozone is an illusion, a facade maintained by cheap credit and political rhetoric. The core problem isn't a temporary downturn, it's the very architecture of the Union itself. The Euro's design was flawed from the very beginning, built not on the diverse needs of Europe, but on German economic preferences. The currency was supposed to bring economies closer together. Instead, it has often created divergence. It was supposed to create a unified economic bloc, but instead it has created a multi-speed Europe, perpetually fragmented. The promise was shared prosperity. The reality has often been asymmetric pain, where the system's rules benefit some members at the expense of the others. This isn't just a fringe theory. The evidence is hiding in the plain sight. Let's peel back the layers and expose the proof of the Eurozone's fragility. We will look at three key pieces of evidence. First, the startling weakness of the supposed anchor, the German economy. The engine of Europe isn't just sputtering, it's facing its most significant challenge in decades. Second, we will dissect the great, unbridgeable chasm that has torn the continent in two, the North-South divide. a structural imbalance that the euro has struggled to fix. And third, we'll look at the European banking system, where a silent crisis continues to loom. This is the proof. This is the story they don't want you to hear. For decades, the entire European project has rested on one assumption: the perpetual strength of the German economy. Germany was the bedrock, the industrial powerhouse that would pull the rest of the continent along. As long as the German engine ran smoothly, the Union could weather any storm. But what happens when that engine stalls? We are finding that out right now. The story of Germany in 2025 is not one of strength, but of deep fragility. While politicians cling to slivers of good news, the broader picture is worrying. Yes, business sentiment has seen a flicker of optimism. The IFO Business Climate Index rose slightly in July 2025, but this optimism seems detached from reality. While businesses tell pollsters they feel better, German consumers certainly don't. Consumer confidence remains weak. Retail sales have been volatile, falling in May 2025 after months of sluggishness. Foreign trade, the lifeblood of the German model, is dragging the economy down, with exports projected to contract this year. Now dig deeper and it gets darker. The manufacturing sector, Germany's crown jewel, is in turmoil. It's being battered by high energy costs, sluggish global demand, and fierce competition, mainly from China. As a result, business insolvencies have risen sharply, reaching their highest levels since the 2009 financial crisis. Recent reports show corporate insolvencies are substantially higher than pre-pandemic levels, a clear sign of an economy in distress. The reason Germany's weakness is so dangerous for the Eurozone is that the system was designed around its strengths. The euro itself was in main ways modeled on the German Deutsche Mark, with the Maastricht convergence criteria reflecting Germany's stability-oriented culture. These rules focused on nominal targets like price stability and arbitrary fiscal limits, a 3% deficit and 60% debt to GDP ratio, while ignoring real economic differences like current account imbalances or structural needs. This German-centric design created a deflationary bias across the continent, as monetary policy suited for an export powerhouse like Germany proved punishing for others. For years, Germany benefited hugely from this. The euro gave it an undervalued currency, supercharging its exports. Meanwhile, countries in the south found themselves shackled to an overvalued currency, making their industries uncompetitive. Germany's success was directly linked to the struggles of its partners. Now, that model is breaking. The sources of Germany's growth are drying up. The stalling of the German engine exposes the Eurozone's central vulnerability. It is a deeply hierarchical system with a weakening core. A weak Germany is less able to backstop the rest of the Eurozone and is more likely to turn inward. The anchor of European stability has come loose, and the entire ship is being tossed in the storm. If the German crisis reveals weakness at the core, the North-South divide exposes the project's original sin, its institutional dysfunction. Nowhere is this dysfunction clearer than in the persistence of barriers within the supposedly single market. The existence of 27 different national tax systems within an integrated market creates huge compliance costs and legal uncertainties that discourage cross-border investment. The wide divergence in corporate tax rates distorts economic activity and undermines fair competition. This has led to harmful tax competition, a race to the bottom, where member states try to attract investments with preferential tax treatment instead of improving productivity. This dynamic not only reduces government revenues needed for public investment, but it also creates deep resentment. In fact, survey evidence from Euro chambers indicates that dealing with different contractual and legal practices remains a primary obstacle to doing business across borders in the EU. This dysfunction extends to monetary policy. The European Central Bank is forced to apply a one-size-fits-all interest rate to vastly different economies. A rate that might be right for the Eurozone average can fuel booms in one country while deepening recessions in another, creating persistent instability. Today, that divide is as wide as ever. In a strange twist in 2025, southern countries like Spain and Greece have seen stronger economic performance, while northern countries like Germany are stagnating. Commentators have cheered this as convergence, but it's a mirage. It's happening because the north is slowing down, not because the south is catching up structurally. This is not convergence. It's a symptom of a new phase of the crisis. The fundamental problem has never been fixed: the attempt to run a monetary union without a fiscal union. A monetary union without a fiscal one lacks the automatic stabilizers seen in places like the United States. In the US, federal money automatically flows from prosperous states to struggling ones, cushioning economic shocks. The Eurozone has no such mechanism. This divide is not a bug in the system. It is the system, and it is pulling the union apart. The information I'm talking about is crucial for understanding the real economic risks we are all facing. If you find this analysis valuable, please take a moment to hit that like button and subscribe to the channel. It makes a huge difference. Now, let's get to our final and perhaps most critical piece of proof. The third piece of evidence lies within the Eurozone's banking system. On the surface, things look fine. Banks are posting solid profits and seem to have navigated recent uncertainty well. But this stability masks a deep structural rot. The European banking system is fragmented, incomplete, and vulnerable. The first flaw is the doom loop, the toxic link between governments and their banks. Here's how it works. Banks hold their own government's debt. If investors fear government default, that debt's value plummets, hunting the banks. This makes people fear for the banks, requiring a government bailout, which an already struggling government cannot afford. It's a vicious cycle. The banking union was supposed to break this loop. It was meant to have three parts: common supervision, a mechanism to handle failing banks, and, most importantly, a European Deposit Insurance Scheme, the EDIS, to provide a common guarantee for all depositors. But the project is dangerously incomplete. The third leg, common deposit insurance, is missing. Why? The same old north-south divide. Germany and other northern countries have blocked it, fearing their taxpayers would end up paying for bank failures in the south. This means a deposit in a German bank is still seen as safer than one in an Italian bank. The doom loop hasn't been broken, it's just on pause. The banking union is a two-legged stool and just as unstable as ever. The second silent crisis is the financial sector's dependence on American markets, which limits European autonomy and undermines the euro's international role, as US banks dominate key segments of European finance. In derivatives trading, American institutions control nearly 28% of the EU market. This reliance on US funding and trading platforms creates vulnerabilities, meaning American regulatory and monetary policy can directly impact European financial conditions and compromise the Eurozone sovereignty. The stark valuation gap between US and European banks tells the story. With the market capitalization of a single bank like JP Morgan at times exceeding the combined value of Europe's 10 largest banks, this reflects structural weaknesses like lower profitability and limited global reach that constrain European banks' ability to support the continent's own economy. Finally, the one-size-fits-all monetary policy creates hidden stress. An interest rate that's right for a stagnant Germany could fuel a bubble in a faster-growing economy. These tensions are reflected in different borrowing costs across the Union, undermining the idea of a single market. The silent crisis in Europe's banks is a ticking time bomb, waiting for the next downturn to detonate. The story of the Eurozone is a tragedy of a noble idea, a continent united in peace, undermined by flawed economics and national interests. The evidence we have examined today points to one conclusion: the project has failed to live up to its promise. The official narrative of stability creates a dangerous complacency, preventing a serious discussion about the profound risks we face. By pretending the system is sound, policymakers ensure that when the next crisis hits, they will be just as unprepared as they were last time. The path ahead is uncertain. Will it be a slow unraveling or a sudden collapse? Will leaders find the courage for a radical change, or will they keep kicking the can down the road until there is no road left? These are no longer academic questions. The foundations are trembling. To ignore the warning signs is to invite disaster. What do you think comes next? Is there a path to reform, or is a slow decline inevitable? Let me know your thoughts in the comments below. I will explore these in the very next Economic Thursdays video. See you all next time. Bye bye.